The tale of Zynga posting a loss in its first earnings report as a public company. And we got Shayndi Raice joining us now from the Wall Street Journal in San Francisco. And there she is.
Hi, guys.
Hi. This was, I remember last night on the News Hub when this was being fed through to my ear. This was a confusing operation because there were a lot of things that needed to be stripped out. So as simply as possible, explain what happened.
Basically, Zynga posted a loss primarily due to two things. One was that they had to pay out the restricted stock units to employees that was triggered by the IPO, and they had about a $510 million charge for that. But second was that their R&D expenses went up eightfold or almost ninefold. And so between those two things, the company posted a loss. And this was while they were able to increase revenues by 59%. So even though they increased revenues, it wasn't enough to cover those losses.
So we're going to have a look at the chart now. Apparently the stock's down about 14% in today's trading. It was wiggling all over the place yesterday in the aftermarket, which made things very confusing. There it is, down about 14%. Sorry, Drew, you were going to ask a question.
No, I was just going to say, so I mean, those are real costs then, right? Paying people and paying for R&D for a game developer. These are, I mean, It's sort of understandable why they're down 14%, I guess. I was surprised by, oh, go on, yeah, no.
I think it's understandable to a certain extent. I think certainly the cost related to paying employees for the IPO, 100% an understandable one-time cost. For the R&D, though, there is something to be concerned about. And the issue there is that Zynga is, and the video game industry in general, a hit-driven business. And so you have to spend a tremendous amount of money on research and development in order to keep coming out with these big hits. And so the fact that a year ago the company was spending, a fraction of what they have to spend now in order to generate hits, and it's still not enough revenue to cover those costs is something to be concerned about. They came out with 11 games last year. Presumably they're going to be coming out with a lot more this year, and that's all because of the R&D costs. So the question is really, can the entire business model sustain itself, or is it too expensive?
To me, Drew, this seems like the movie business. Right? It seems like you put your production money in, and you put 10 films out, and you hope one does well that pays for all of the rest of it, and that's incredibly risky, right? I mean, it really is.
Yeah, less so in video games, right, than in the movie business, which obviously people are really rolling the dice. But yeah, no, to your point, I mean, the R&D costs were actually higher than their entire revenue. Right?
Yes.
Was that so? That seemed kind of extraordinary. One thing I don't understand, like I assume there's like a human capital driven business, so the main R&D cost I would think would be hiring people to do R&D, right? So how does that go up 90% or ninefold? Did they hire a bunch more people? Like what is it that?
They hired a tremendous amount of people. I mean, that company is growing so fast. The headcount is something like, almost 3,000 people. And it's, the company's only 4 years old. So in large part, it's due to hiring all those employees. But just one point on the nature of the movie business, their COO has gone to great lengths to try to sort of say that they are not like the movie business, that they're actually more like the TV business. Because when they put out a game, they can tweak that game constantly, which is sort of why they claim that their platform is different than, let's say, an Electronic Arts that puts out a Madden and that's it. You can't update it till the next year's version. With them, they put out a game and they can constantly respond to users' concerns. So it's more like a TV show where, you keep coming back week after week or day after day and you get to see new things. So,
and you get to kill off
just that's their argument.
You get to kill off the unpopular characters. Oh no, we didn't get good ratings. Okay, no, I do see that. That's a great point, isn't it? That's a really good point.
And this is the chief executive's first earnings conference call, right? How did it go?
Well, Mark Pincus actually got one really interesting question towards the end of the earnings call. One of the analysts asked him to discuss his own personal management style because that's an issue that's come up quite a bit in the press. I've written about it in terms of the fact that he asked some early employees to give back some of their stock because he felt that they didn't deserve it, and sort of gave them this ultimatum that they could either give it back or they could be fired. And other press outlets have come out with other types of stories about his management style, that he's overly demanding and he has unrealistic expectations. And so it was really interesting to see the analysts raise that as a question. He completely dodged the question. He just said that, one of the hard things for him during the company's quiet period was that they weren't able to respond to all the accusations against them, and that essentially said you should look at the walls on Zynga because that's his management style. That was about as far as he went. But he pretty much stayed out of the spotlight in the earnings call and let the other executives handle it, the chief operating officer and the CFO.
He was probably too busy hiring people, is what he was. His finger on the hiring button is what it is, by the sound of it. 3,000 people in a few years. Anyway, Shayndi Raice with the Wall Street Journal in San Francisco. Great stuff.